Global investments. Investors entertain the following advantages by considering global or worldwide opportunities of investments. These advantages might include: first, broaden horizons, where investors consider worldwide investment opportunities rather than only home country. Second, return enhancement, as certain countries may have potential high growth compared to home country. Third, risk reduction, as diversification is the cornerstone concept in the investment, which could be achieved better by considering global investments. Fourth, global economy, as the world is heading through international free trade, companies have potential for growth worldwide. Attractive companies might be found in a country other than home country. This table shows different countries' bond return over 18 years. Notice the variation among bonds return in different countries, as well as the standard deviation differences in each country. This table presents equity market returns between 1997 till 2003 for 34 major capital markets. Countries varies in the annual capital return from year to year. For example, Mexico stock market return in 2003 was 31.46% and ranked as 28, compared to their return in 1997 of 54.21% and ranked as number 1 among other major stock markets. Correlation coefficients between US dollar rates of return on bonds in the US and major foreign markets between 1985 till 2003 are presented in this table. Note the variations of correlation coefficients among different countries. The highest correlation coefficient is in Canada, which means the lowest benefit could be achieved for American investor. And the highest was in Japan, where the maximum benefit could be achieved for American investor by reducing the portfolio risk. Why correlation coefficients differ in different countries? Actually, countries differ in many aspects, including the international trade pattern, economic growth, and fiscal policies. Correlation coefficient between US dollar rates of return on stocks in the US and major foreign markets between 1985 till 2003 are presented in this table. The correlation of world equity markets resembles that of bond markets, except that the correlations are slightly higher. Diversification reduces the standard deviation of portfolio relative to standard deviation of typical stock. Diversification can be achieved in a home country and it's labeled as domestic diversification. Standard deviation can be further reduced by diversification internationally. Diversification across countries alone or diversification across industries alone can reduce standard deviation, but with a limited degree. Significant reduction on standard deviation can be achieved if diversification happened across both countries and industries simultaneously.